So second is futures contract. It is as similar to forward contract in all ways, but only difference is it is traded in on an exchange with certain standardized norms for trading. So futures contract has got certain standards. So has got certain features. First one is it is standardized. The futures contract has certain standardization specification regarding the quantity of the asset, the quality of the asset, the date and month of delivery, the unit of delivery, price quotation, location of settlement. All these things are standardized and it is regulated by a recognized stock exchange. Second, it has got a clearing house. So clearing house act as an intermediary or a middleman in a futures contract. It gives the guarantee for the performance of the parties of each transaction. The clearinghouse is the counterparty to every contract. The third is settlement price. So futures contract are performed through a particular exchange. So at the close of the day of trading, each contract is marked to the market. For this, exchange establishes a settlement price. This settlement price is used for uh, computing the profit or loss on each contract for that day. Accordingly, the members' account are credited or debited. Next one, daily settlement. And margin. The another main feature of futures contract is that when a person is into a contract, he has to deposit a margin amount with the exchange. So this margin amount will be utilized for daily settlement between the person who are into contract. According to the day's transaction, either their account will be debited or credited. Next is a tick size. The futures priced are exposed in a currency units with a minimum price movement called as tick size. This means that the future price must be rounded to the nearest tick. So usually in a stock exchange when we are trading, it will be in India it is 95 paise, 90 paise, 85 paise. So the difference is 5 paise. So the minimum is that 5 paise. So whenever there is a change, they have to show it in that format. You cannot show 80. They cannot show in a stock exchange 87 paise, 93 paise like that. So that is what we call it as tick size. Cash settlement. So most of the futures contract are settled in cash by having the short or long. To make a cash payment on the difference between the future price at which the contract was entered and the cash price at the expiration date. This is done because it is inconvenient or impossible to deliver sometimes the underlying asset. Next, delivery. A future contract or executed on the expiry date, the counterparty with a short position are obliged to make delivery to the exchange, whereas the exchange is obliged to make delivery to the uh, person with long position on the period of expiry. The last feature of futures contract is regulation. So the main difference between the futures and forward contract is that the futures contract are regulated through exchange, but forward contracts are self-regulated by the counterparties themselves. So these are the features of future contract. First, it is standardized. Second, it has got a clearing house. There is a settlement price, and the settlement price is calculated daily. And the person with short run and long run, they have to deposit a margin amount with the exchange so that their account will be debited or credited accordingly. Each day settlement, it is based on the tick size, and cash settlement is made daily, and on the date of delivery, if it is not possible, the underlying asset will not be delivered. But if it is delivered, the counterparty is obliged to deliver it to the exchange, and the exchange is obliged to deliver it to the person with long position. And finally, as I said earlier, it is fully regulated. The third is options contract. So option may be defined as a contract between two parties whereby one party obtains the right but not the obligation to buy or sell a particular asset at a specified date and at a specified price on or before a specified date. So let us take an example. The current price of R Limited share is 750 per share. So X is having 1000 shares. X is having 1000 shares of this R Limited and is worried in the decline in price of shares. So the option put contract is available in the exchange. So there is a put contract, option put contract. Is available in the exchange. So what X has to do is he should pay a premium amount. So this is available. It is of 800 per share. In next 2 months delivery. And the premium is rupees 10 per share. So this is called as strike price at a strike price of 800 per share. So in this way, X has edged. X has edged is risk of price full of stock. So X will excise the put option if the price of the stock goes down below 790. So he will excise this put option if the price of the stock goes out below 790, and he will get 800 per share. And he will not excise the option if the price moves more than rupees 800. If the price moves more than 800 after 2 months, he will not excise this option. So when he is not excising this option, the premium amount which he paid to the exchange, rupees 10 per share, it it will be the loss for the loss for him. It alone will be the loss for him. There is no other loss for him. But if he is not buying this put option, in case if share value falls down, he will face a greater loss. So X will not excise the put option if the price is more than rupees 800 on the excise date. In case of option, buyer has a limited loss and unlimited profit. I hope this example is clear. Next is swap contract. So swap or most popular derivatives derivative instruments in the recent year all over the world. So a swap is an agreement between two parties to exchange the cash flow in the future. So under the swap agreement, various terms like the date when the cash flow are to be paid, the currency in which to be paid, and the mode of payment are determined and finalized by the parties. Usually, the calculation of cash flow involves the future value of one or more market variable. There are two forms of swap contract. One is interest rate swap, and another one is currency rate swap. So, in interest rate swaps, one party agrees to pay the other party interest at a fixed rate on a notional principal value, and in return it receives interest at a floating rate on the same principal notional amount for a specified period. That is why it is called a swap. So one will be paying fixed rate, another will be paying floating rate. So this is called as swapping. So whereas in case of currency rate swap, it involves the exchange of interest flow in one currency for the interest flow in other currency. The same interest rate swap when it is done between two countries, and this is done in USA and this is done in India, then it is called as currency rate swap. So otherwise we can say that it requires the exchange flow in two currencies is what we call it as currency swap. Okay, now let us take an example of futures contract. Okay, let us consider the major players, or otherwise we can call it as a major participants of derivatives market. So the different traders active in the derivative market can be categorized into three categories. The first one we call him as an hedger. Edges. The first one is an edges. Edging is an activity to reduce the risk, and the edger is a person who faces the risk associated with price movement of an asset and who uses a derivative as a mean of reducing that risk. I told you about the options contract in which X uh, feels that the share price may fall down and so he is going to buy a put option which is put in the stock exchange. So he wants to reduce the risk. So he is called as an hedger. Um, so hedger is a trader who enters the future market to reduce the pre-existing risk. So let us give another example. So an importer wants to import some goods from USA at $100, and the payment is to be made after 3 months. Suppose today the dollar price quote, uh, let me consider India, it is $1 is equal to 80, 80 rupees. So therefore, the payment is to be made today. The cost of goods in Indian currency will be 80 into 100. So it is going to be 8,000. 8,000 rupees. But due to uncertainty in future movement of price, there may be a chance of dollar appreciation, thereby increasing the cost of goods for the importer. In that case, there would be a loss to the importer. To avoid such risk, he enters into a contract for 3 months, future contract, to buy at $100. This will fix the price to be paid to the US exporter at rupees 8,000 regardless at rupees 8,000 regardless of the dollar price quoted after 3 months, that may appreciate or depreciate. So if he is going to enter into a contract for today, you will be entering it as $1, which may cost him 80 rupees. So in future, if it goes to 90 rupees, there is no issue. He will not be paying 9,000. He will be paying only 8,000. Whereas if it decreases to 70, again he will not be paying 7,000. He will be paying only 8,000. So whether it is going to depreciate or appreciate, it doesn't matter. So this is what we call it as hedging, expecting that future may bring loss. To avoid such loss, we are fixing something uh, for what is going to happen in the future. That is hedging. The next is speculation. Otherwise, we call them as a speculators. So, while hedgers are interested in reducing or eliminating the risk, speculators buy and sell the derivatives to make profit and not to reduce the risk. They buy when they believe future or options to be underpriced and sell when they view them as overpriced. The third participant is arbitrager. So, an arbitrator is a person who simultaneously enters into a transaction in two or more markets to take advantage of price differences in those markets. It is totally a viceless activity. If the future price of an asset are very high relative to the cash price, an arbitrator will make profit by buying the asset in the spot market and simultaneously selling in the future. Next, forward contract mechanisms. So the trading mechanism of forward contract can be better understood with the following example. So let us take Mr. X. This Mr. X is a wholesale sugar dealer, and Mr. Y is a prospective buyer. Mr. Y is a prospective buyer. The current price on 1st April, the price of sugar on 1st April is 23 per kg. Mr. Y agrees to buy 50 kgs of sugar at 25 per kg after 3 months. So the current price, that is spot price. So Mr. Y agrees to buy 50 kgs of sugar at rupees 25 per kg after 3 months. The price is arrived at on the basis of prevailing market conditions and future perception about the price of the sugar. If on 1st July, that is after 3 months, 1st July, the market price of the sugar is rupees 30. The market price of the sugar is rupees 30 per kg. Then Y is the gainer because he is going to pay only 25 per kg because there is a forward contract between X and Y. After 3 months he will procure 50 kgs of sugar for 25 per kg, but the present market price is 30 per kg. So who is going to gain? Y is going to gain the profit by rupees 5. Y is going to gain by rupees 5 per kg. If the price of the sugar on 1st July, if it is rupees 20 per kg, then the gainer is Mr. X. X is going to be the gainer because if uh, he's going to sell it, he'll be selling it for 20, but he has sold it for 25 per kg. So here he is gaining 5 rupees. So if it is 30 per kg, Y will be the gainer by 5 per kg. If on 1st July the market price of the sugar is 20 per kg, then at that time X is going to be the gainer. So one party gains and another party loss by the same amount. Hence, the profit or loss payoff is symmetrical. Okay, the, if one party is gaining, the other party is losing. So the profit or loss is symmetrical. Does this mean one party loss has to lose? No, because by limiting my losses, I'm in a better control of my business. By limiting my losses, I'm in better control of my business. Let us understand this from the perspective of both Mr. X and Mr. Y. Mr. X will gain even if the price of the sugar is rupees 20. See, if it is going to be 20, even X will gain because at the time of entering the contract with Mr. Y, Mr. X did not know what exactly the price of sugar would be after 3 months. So, by agreeing to sell sugar at rupees 25 a kg, Mr. X is assured of certain ca- earning based on which he can now plan financial assistance needed for his business. Similarly, Mr. Y also knows that he will have to sell out a fixed amount based on which he too can take care of financial needs of his business. It will help Mr. Y to control his loss. So the important terminology used in forward contract are first one is underlying asset. This refers to the asset on which forward contract is made. The long position buys the asset in future and short position sells the asset in the future. So can you tell me which is the underlying asset in this example? Can anyone tell me what is the underlying asset in this? Yes, sugar is the underlying asset. In this, sugar is the underlying asset. Next, regarding the long position, and third is short position. So the party who agrees to buy an underlying asset in the future date is said to have a long position. So here Mr. Y is having the long position because he agrees to buy the sugar in the future date. So Y is said to be in long position. So the party that agrees to sell an underlying asset in the future date is said to be in short position. So here it is Mr. X. So Mr. Y and Mr. X. So Mr. Y is in long position, Mr. X is in short position. The person who is going to sell in a future date is said to be in short position. The person who is going to buy in the future date is said to be in long position. The fourth term is spot position. This is the quoted price of the underlying asset for buying and selling at the spot or immediate delivery. So this is called as, sorry, it's not position, spot price. So this is the spot price. 23 per kg is the spot price. Fifth, future spot price. In this example, we are having two future spot price. One is rupees 30 and another one is rupees 20. In future, after 3 months, the spot price of the underlying asset on the date of forward contract expires. It depends on the market condition prevailing at the expiring date. This 30 rupees or 20 rupees, whatever it is due to the market condition that is prevailing at that time. So we call it as future spot price. Sixth, expiration date. So expiration date. This is the expiration date. 3 months. When they are going to enter into the contract on 1st April. If it is for 3 months, then it is going to be 1st July. So that is called as expiration date. The date on which the forward contract expires. It is also called as maturity date. And the fifth one is, seventh one, delivery price. The specified price of the underlying asset at which the forward contract is settled on the expiration date is said to be the delivery price. So in this example, the delivery price is rupees 25. So the underlying, let us come up with this example. The underlying asset is, in this case, it is sugar. The sugar is the underlying asset of the derivative contract. The person who is going to buy the underlying asset is said to be in the long position. The person who is going to sell the underlying asset is said to be in short position. Spot price is the price on the date of contract. So in this case, it is 23 per kg. Future spot price is the spot price on the date of expiry, on the date of maturity of the contract. If the spot price may be due to some market condition, it may change. It won't be the same. So depending on the market condition, it may vary. Expiration date is the maturity date of the contract, and the delivery price is the price at which the person, the long position and short position, has agreed to settle. Is called as delivery price. So in this, the delivery price is 25 per kg. Next, mechanisms of future contract. So a future contract is similar to the forward contract except for two important differences. Intermediate gain or loss or posted each day during the life of the future contract. This is also known as marking to the market. The intermediate gain or losses are given by the difference between today's future price and yesterday's future price. Secondly, futures contract are traded in an organized exchange with the standardized terms. An investor wishing to take position either long or short in future contract comes in contact with the registered broker authorized to transact on the floor of exchange. The investor opens an account with the broker member. The broker collects initial margin from the investors, transacts on behalf of the investor, record all transactions and report to the clearing house attached to the exchange on regular basis. Usually there are two kinds of broker found. One is a commission broker and another one is a local broker. The commission broker mm, cha- charges a fee in form of commission on the transaction value. The latter is called as a local trader. Uh, they trade on their own behalf. So the usually the terminologies which is used in future contract is asset. First one is an asset. In forward, we have seen underlying asset, but there is a little difference between that and this. This is most important specification in future contract. The exchange must stipulate the quality and the grade of the commodity. The issue of quality does not arise in financial assets. Second, the contract size. Is the amount of asset that has to be delivered under one contract. The contract size differs with the derivatives contract and the type of underlying asset. Third is a delivering month. These refers to those months when futures will mature. Usually, the last Thursday of the expiring month or the previous trading day, if the last Thursday uh, is a trading holiday. Fourth is trading cycle. The futures contract will have a maximum of 3 months. So the trading cycle, the near month is the first month, the next month is the second month, and the far month is the third. So new contract will be introduced on the next trading day following the expiry of the near month contract. Example for let us take January expiring contract expires on the last Thursday of January. On the Friday following the last Thursday, a new contract having a 3 months expiry is introduced for trading. Price limit. It is bounded on the maximum price variation permitted in a day's trading. The exchange sets a daily price movement limit of underlying asset, which normally matches the initial margin money collected against the future contract. When the price increases by amount equaling the daily price limit, it is set limit up, and when declined by the same value, it is refers to as limit down. The exchange may temporarily discontinue figure trading for the day on a particular contract if the contract is limit up or limit down. It's cost of carry. So this is an important one for the valuation of futures as well as forward contract. So the relationship between the future price and the spot price can be summarized in terms of what is known as the cost of carry. This measures the storage cost plus the interest that is to be paid to finance the asset less the income earned on the asset is what we call it as cost of carry. initial margin, the amount that must be deposited by both the parties, long position and short position holders, at the time of starting the contract is what we call it as initial margin. Marking to market. At the end of each trading day, the margin account is adjusted to reflect the investor's gain or loss depending upon the future closing prices. Next is maintenance of margin. This is somewhat lower than the initial margin. This is said to ensure that the balance in the margin account never becomes negative. If the balance in the margin account falls below the maintenance margin, the investor will receive a margin call and is expected to top up the margin account to the initial margin level before trading commences the next day. So these are the certain terminologies which is being used in a futures contract. So pricing forward contract. So before discussing pricing of forward, we must distinguish between investment product and consumption product. So in investment product are individual stocks, stock indices, and those in which investor takes position for investment purposes, whereas consumption products or agri products, gold, silver, etc. So forward are priced using cost of carry model and in such a manner that no arbitrage opportunities exist. Depending on the nature of carry cost associated with the asset and the carry return principle, the model is modified. So carry cost includes the holding cost for the underlying asset. For commodities, this may refer to the warehousing cost, insurance expenses, transportation cost, etc. For finance product, carry cost includes financing cost like interest charges on borrowing, the cash to take position in the asset. Carry return principle refers to the income generated by the asset. For finance, carry return may include a dividend received on shares. So this is based on an assumption that there is a perfect market, that the information flow freely and equal borrowing and lending rates are there in the market. Large market participants are available in the market. So that's what they think. We assume that there is a perfect market. Second, the underlying asset infinitely divisible may not hold goods for all types of commodities. It may depending on the underlying asset. So there is no brokerage fee and no transaction cost. Only one price exists in the market. Absence of any market restrictions, short selling, uh, margin money, or are totally absent. So, what is the cost of carrying model? The formula is like this: forward price equal to forward price equal to spot price plus carry cost minus carry return. So there are three situations of pricing forward depending on the underlying asset. The first one is underlying asset with no income generation. Underlying asset with no income generation. Underlying asset providing fixed amount of return or income. And the third is underlying asset providing known yield. So we will be calculating the forward price under these three categories. In first one, underlying asset with no income generation. So refers to those in which we will not be generating any income will not be generated. The share without dividend. Next, second is underlying asset providing fixed amount of return, and the underlying asset providing no yield. So before getting into the valuation of forward contract, we should know what is compounding. Compounding is a quantitative tool which is used to know the lump sum value of the proceeds received in a particular period. So the terminal value equal to A into 1 plus R to the power n. So A is the amount for investment, R is the rate of interest, n is the period, and m n is the period. So this is where it is if it is compounded many times per annum. If it is compounded many times per annum, we have to use a separate formula. uh, in this case it is compounded only once in a year per annum. So a into 1 plus r to the power n. If it is compounded many times in a year, we will be using this formula. So terminal value equal to a into 1 plus r divided by m to the power mn. So here the m stands for the number of times of compounding. If in a year it is compounded 2 times, then it is 2. So m refers to the number of times it is being compounded. So suppose we take A, the investment is 100. The rate of interest is 10 per annum. Number of year is 1 year. And it is compounded once per annum. Then the calculation terminal value will be TV. Terminal value will be 100 into 1 plus 10 percentage, that is 10 divided by 100 to the power 1. Number of years 1 year. So the value you will be getting is 110. If it is compounded twice in a year, we will be calculating it like this. TV equal to 100 plus 1 plus rate of interest is 10. So 10 divided by 100, you will get 0.1. 10 percentage, 10 by divided by 100, you will get 0.1. Again, when you divide it by number of times it is compounded, I said it is 2 times. So 0.1 divided by 2, m into 1, 2, so 2 into 1. So 100 into 1 plus 0.05 2 into 1 to the power 2. So this will be like this: 100 into 1.05 into 1.05. So you will get 110.25. So this is an example for compounding. When you know this only, it is possible for us to use cost of carry model. So we continue next class with the pricing of forward contract. Have any doubt up to this?